In today's fiercely competitive business landscape, achieving profitability is paramount. Companies are constantly seeking ways to stay ahead of the curve and maximize their financial performance. For manufacturing companies, understanding and controlling costs is the cornerstone of success. It's not just about cutting expenses, but about strategically managing resources to drive efficiency. Manufacturing cost analysis provides the crucial insights needed to make informed decisions, optimize operations, and ultimately enhance profitability. It allows businesses to see the bigger picture and identify key areas for improvement. Without a firm grasp of manufacturing costs, businesses operate in the dark, vulnerable to inefficiencies and financial vulnerabilities. This lack of clarity can lead to unexpected expenses and reduced profit margins. Mastering manufacturing cost analysis empowers businesses to accurately determine the cost of producing goods, providing a clear understanding of profitability. This detailed breakdown helps in setting realistic financial goals and tracking progress. This knowledge enables effective pricing strategies, ensuring that products are priced competitively while maintaining healthy profit margins. It also helps in adjusting prices in response to market changes. Moreover, by meticulously analyzing costs, manufacturers can pinpoint areas of waste and inefficiency, streamlining processes to reduce expenses and boost overall productivity. This continuous improvement cycle is essential for staying competitive. In an era of rapidly evolving technologies and global competition, the ability to adapt and innovate is paramount. Staying ahead requires constant vigilance and a proactive approach to cost management. Manufacturing cost analysis plays a critical role in this process by providing the financial insights needed to evaluate new technologies, assess the viability of new product lines, and make strategic investments that drive growth and innovation. It ensures that every decision is backed by solid data. By embracing manufacturing cost analysis, businesses gain a competitive edge, ensuring their long-term sustainability and success in the marketplace. This strategic approach to cost management is the key to thriving in today's dynamic business environment. Cost accounting is the backbone of manufacturing cost analysis, providing the framework for tracking, classifying, and analyzing the costs associated with producing goods. Unlike financial accounting, which focuses on reporting financial information to external stakeholders, cost accounting delves into the internal workings of a manufacturing operation, providing managers with the detailed cost information they need to make informed decisions. Through a systematic approach, cost accounting captures data on direct materials, direct labor, and manufacturing overhead, assigning these costs to specific products or processes. This meticulous tracking allows businesses to determine the true cost of production, enabling accurate pricing, profitability analysis, and informed decision-making. Cost accounting goes beyond simply tracking costs. It provides insights into cost behavior, helping managers understand how costs fluctuate with changes in production volume, process efficiency, and other factors. This understanding is crucial for cost control, allowing businesses to identify cost drivers and implement measures to optimize resource allocation and minimize expenses. By providing a clear and comprehensive view of manufacturing costs, cost accounting empowers businesses to make data-driven decisions, optimize operations, and achieve their financial objectives. To effectively analyze manufacturing costs, it's essential to have a clear understanding of the manufacturing process itself, breaking it down into its constituent parts, each representing a cost center. This cost-oriented perspective allows businesses to track costs at a granular level, identifying areas of inefficiency and implementing targeted cost optimization measures. The manufacturing process typically begins with the acquisition of raw materials, which are then transformed into finished goods through a series of steps, each involving labor, machinery, and overhead costs. By dividing the process into distinct cost centers such as material handling, production departments, and assembly line, businesses can isolate costs, identify areas of high expense, and implement targeted improvements. Accurate cost allocation is crucial for effective cost analysis. This involves assigning costs to specific products or processes based on their actual consumption of resources. By accurately allocating costs, businesses gain a realistic understanding of product profitability, avoiding cross-subsidization and ensuring that pricing decisions are based on sound cost data. Understanding the manufacturing process from a cost perspective empowers businesses to optimize resource allocation, streamline operations, and achieve cost efficiencies throughout the production cycle. Section 4, the fundamental trio: direct materials, direct labor, and manufacturing overhead. These three components are the backbone of any manufacturing process. Manufacturing costs can be broadly categorized into three main components: direct materials, direct labor, and manufacturing overhead. Each of these elements plays a crucial role in the overall cost structure. These cost elements form the foundation of manufacturing cost analysis, providing the basis for understanding the total cost of producing goods. Without a clear grasp of these components, managing production costs effectively becomes challenging. Direct materials encompass all the raw materials and components that are directly used in the production of finished goods. This includes everything from the steel used in automobiles to the fabric used in clothing. These materials are essential as they form the physical substance of the final product. Without them, production cannot proceed. Direct labor refers to the wages and benefits paid to employees who are directly involved in the manufacturing process, such as machine operators, assembly line workers, and quality control inspectors. These workers are the hands-on force driving production. Manufacturing overhead, often referred to as indirect costs, encompasses all the other expenses incurred in the manufacturing process that cannot be directly traced to a specific product or service. These costs are vital for maintaining the production environment. This includes costs such as rent, utilities, depreciation on factory equipment, and the salaries of production supervisors. These expenses ensure that the factory operates smoothly and efficiently. Understanding the distinction between these three cost components is essential for accurate cost accounting and effective cost management. It allows businesses to allocate resources more efficiently. By tracking and analyzing each element separately, businesses gain a comprehensive understanding of their cost structure and can identify opportunities for cost optimization. This detailed analysis is key to maintaining profitability and competitiveness in the market. Section 5. Unraveling the complexities of manufacturing overhead. Manufacturing overhead, encompassing a wide range of indirect costs, presents a unique challenge in cost analysis due to its complex nature and the difficulty in directly attributing these costs to specific products or services. Accurately allocating manufacturing overhead is crucial for determining the true cost of production and making informed pricing and product mix decisions. One common method for allocating overhead is to use a predetermined overhead rate, which is calculated by dividing the total estimated overhead costs for a period by a chosen cost driver, such as direct labor hours or machine hours. This rate is then applied to individual products or services based on their consumption of the chosen cost driver. However, the selection of an appropriate cost driver is essential for accurate overhead allocation. Using an inaccurate or irrelevant cost driver can lead to distorted cost information, potentially resulting in poor pricing decisions and misinformed product mix choices. Understanding the complexities of manufacturing overhead and implementing robust methods for its allocation is crucial for effective cost management and informed decision-making. Section 6. Variable versus fixed costs. Navigating the dynamics of manufacturing expenses. Another crucial aspect of manufacturing cost analysis is understanding the distinction between variable and fixed costs. This distinction is fundamental for any business aiming to manage its expenses effectively. Variable costs, as the name suggests, fluctuate in direct proportion to changes in production volume. These costs are directly tied to the level of output. Examples include direct materials, direct labor, and utilities consumed during production. Essentially, the more you produce, the higher these costs will be. Fixed costs, on the other hand, remain relatively constant regardless of production volume. These costs do not change with the level of output. These costs include expenses such as rent, insurance, property taxes, and depreciation on factory equipment. They are incurred even if production is halted. Understanding this distinction is vital for cost behavior analysis, allowing businesses to predict how costs will change in response to fluctuations in production levels. This insight is crucial for strategic planning. This understanding is particularly important for budgeting and pricing decisions. Accurate cost predictions enable better financial planning and resource allocation. When production volume increases, variable costs will rise accordingly, while fixed costs will remain relatively stable. This dynamic impacts overall cost structure. This knowledge allows businesses to accurately forecast costs at different production levels, set appropriate selling prices, and make informed decisions about production capacity and inventory management. It helps in maintaining a competitive edge. By effectively managing the balance between variable and fixed costs, businesses can optimize their cost structure, improve profitability, and enhance their ability to adapt to changing market conditions. This balance is key to long-term success and sustainability.